So remarkably, we're almost at the end of half of 2025 out the way. I don't know where the year's gone so far, but wanted to sort of hone in on, I suppose, what you've learned so far during the first half of 2025. Yeah, so I think for me doing this, it's a constant learning journey. We've done now over 100 transactions, and I would say that I've learned lots of things new in every single deal. Like even if I look at some of the more recent completions, there's been new stuff that I've not experienced before. So it's a constant learning journey. But I think I think probably the biggest thing for me in 2025 is that there are companies out there that want to undertake M&A. There's a huge opportunity. About a third of businesses are owned by the sort of baby boomer generation, and that gives great opportunities to acquire well-run, profitable businesses. But companies are great at operating. Entrepreneurs are great at being business people, but they don't necessarily know, how to execute an M&A strategy. Where do I find the deal? How do I get it funded? Do I have to sign a PG? How do I structure the deal? There's a lot of unknowns. So, one of the things that we do is we partner with people and we provide that expertise. So, if you have a great business that you want to grow through acquisition, then potentially we could help you with that. So, yeah, it's just a constant learning for me. And I think as we go through the conversations today, we'll talk more specifically about some of those specific things. Okay. So anything else big that you would say you've learned in 2025? Yeah, so I wouldn't say it was new, but I think it's definitely more apparent, is that succession planning continues to be really a challenge in deals. Our model is to buy great businesses that come with a great management team that, essentially we work with that management team to help them grow the business. But, it's not uncommon for an owner operated business that we might want to acquire that they are still very operationally involved in the business. So the business is very much reliant on them. So if they're going to exit as part of the transaction after some sort of handover, in a lot of cases, there isn't that succession planning in place. So one of the things that we've sort of built into our process is actually when we come across those opportunities is as part of our, trying to get the deal done, is we actually work with the business owner to identify what that succession plan looks like. Is there somebody in-house that could be groomed and mentored and coached to basically take over from them? That would always be the ideal scenario because you've got somebody that already understands the actual business itself and how it operates. Or worst case, we look at recruiting somebody from outside, within the industry, and bring them on board, and the owner does a reasonably lengthy handover period to get them up to speed. So whilst that obviously means that deals potentially can take longer, it reduces the risk, and it also helps build the relationship with the business owner because they're actually preparing their business for sale and they're putting it in the best shape possible to enable them to exit. Really, their job is to make themselves redundant from the business so that they don't really get involved in any of the day-to-day. Somebody else is doing that. That would really be a great acquisition opportunity rather than a business that comes without that succession planning, because then there's a huge risk that when the owner leaves, who's going to run the show? Is it you? Do you have that experience? Yes, we can always recruit people, but people from outside of the organization don't necessarily have the relationships with staff and customers and suppliers that an existing management would potentially have. Okay. So do you have the opinion that maybe owners have high expectations, even if the business is fairly reliant on them? Yeah, so I would say that pretty much every day of the week, you're talking to business owners, we're talking to business owners, and they always want more than you're offering, both as an overall valuation and maybe in terms of the sort of initial payment that you might be making to them. And I guess, look, these people that run successful businesses, they wouldn't be successful if they didn't know how to negotiate, and nobody ever takes the first offer. But we have to be realistic. Typically in the UK, in the US, the average SME will sell, a good one will sell for an average of sort of two and a bit multiple of profit. And the reason for that is SMEs are high risk. A lot of goodwill tends to be tied up in the owner. When there's a change of ownership, there's always a risk that custom could go somewhere else, suppliers could get jittery, key staff may leave, not like the new owner. So, if you're paying over the odds for a business and then all of those things come crashing down, essentially you're buying yourself a problem. So you have to factor that into the valuation. And, sometimes it's not just about the financial components of a deal, but it could also be, what are we going to do as a buyer? Are we going to protect their legacy? Are we going to, fire the staff, or are we actually going to mentor them and help them grow the business and take it on to the next level and remove any glass ceiling that may have been there under previous ownership? And, I think we spend as much time trying to convince the business owner that actually we're going to do a good job of looking after their legacy, as well as trying to get the deal structured from a financial point of view, in the right way.
Okay, so have you got an example of how that's sort of been an issue?
Yeah, so I think if we use a recent deal that we've completed on, this was a business that was making just shy of 2 million, so it was a UK deal, so 2 million of EBITDA. So pretty good, successful business in the construction space. And when conversation started, the business owner wanted the number to be at least 10 million in terms of an acquisition price, and we actually acquired it for 5.5 million, so almost half of that expectation. But we spent probably a good 8 or 9 months working through a process with the seller to convince them that actually we're going to do a good job of acquiring their business, and ultimately, because we're doing a leveraged buyout and we're using the assets of the company to, fund the transaction with some sort of seller financing, it was as much about not just convincing them of our operational and industry expertise, but also that the cash flow of the business wasn't going to be stressed because we were over leveraging ourselves. And if we paid 10 million, then we wouldn't have been able to afford it. And being able to actually show that logic in spreadsheets and financial models so that they can see, well, look, yeah, I'm not getting my 10 million, I'm getting half of that, but it's a fair price, it's affordable, and these guys are going to do a good job of running my business. So, obviously that doesn't fly with everybody. And, this is a bit of a numbers game. You've got to have lots of those types of conversations with opportunities before you find that right motivated seller. And then you can bring all of those things together.
Okay, so one thing that must be quite challenging, I think, is funding. It's forever a changing landscape over the last 12 months, especially with everything that goes on, I suppose, in the world right now. How do you find that during 2025?
Yeah, I would definitely say that the opportunities got bigger in terms of the number of SMEs that are owned by baby boomers that potentially could be acquired. The pool of opportunity is bigger, but the pool for lending is a lot less. Banks are very cautious. SME acquisitions has always been high risk because there tends to be a lot of goodwill tied up in the owner, and that's reflected in a finite pool of lenders that will do these types of transactions. Even if you've got masses of experience, you've done lots of deals before, the thing that you won't have is experience of running that specific business and all the nuances that go with that. So lenders always see when there's a change of control that it's high risk. There's a risk that the business performance will not continue. So do they want to deploy capital into that transaction, or would they rather go and lend to a much larger business with a more diverse portfolio? So of course there are funding solutions out there. We deploy a leveraged buyout model. We leverage the assets of the target, and we developed a process that works to be able to go out and raise the money to do those transactions. But it's certainly been more challenging, and I think there's definitely had to be, in some scenarios, we've had to be more creative. At the end of the day, it boils down to, what's the motivation of the seller? They want to exit. What's the reason for that exit? And if there's something pressing that's causing that, it's really about then trying to craft a deal that's going to get them to that point of exit and retired, so they can do whatever it is they need to do and sort out whatever their issue is. And it's really then about being creative to try and find a solution to all of those things. Gets them the exit, gets us the business, gets it funded in line with people's expectations, and then it's down to whether what a willing buyer and willing seller are prepared to trade at, and whether or not that's all affordable and viable and fits with people's motivation. If you're interested in mergers and acquisitions, we have a free to join community of deal makers around the world where we share knowledge, expertise, deals, and joint ventures. I produce regular content there, and it's the first place that you can see it. So if you'd like to find out more about this and how we can joint venture together, I guess the vast majority of deals that we have done have been with joint venture partners. And I guess to get to 100 plus deals, there's only so many hours in the day. So by sharing the work with like-minded others, we can increase that bandwidth. So to learn more about this and to join our community, visit buybuildsellprogram.com.
How creative can things ultimately become? So for a lot of people, they might think that maybe there's a payment up front and then there's some deferred payments. How creative can things be?
Yeah, so it's not uncommon for I'll give you an example. So it's not uncommon for an SME to business owner. They've probably spent 20, 30 years building a business, being successful, consistently profitable, and then they want to get to a point of exit. Now, over that 20, 30 years, they've probably earned some good money. They've taken dividends. It's got them the nice house, the nice car. They've got some money in the bank. They're maybe free of any sort of mortgage or financial commitments. They're in a comfortable position. So I'm not saying that those sorts of people are going to give you their business, but money tends to be sometimes almost secondary in their thought process. So look, if this works well, if there is a real motivation, so it's not just, you know what, I'm a bit old and I think I might need to retire. Maybe they've got a health issue and they need to spend time on, getting themselves back to good health, and the stresses and pressure of running a business can be, take its toll. So, one way to be creative in that scenario, which is we've done 2 of these deals in the last 12 months where they're literally all seller finance. There's no financial institution involved whatsoever. And essentially you pay them over a period of time out of the future cash flows of the business. Why would a seller do that? Well, if there's a reason why they've got to sell, you're offering them that. Yes, they're not getting any money or much money at closing. They're going to have to get paid over a period of time. But look, if they want an exit, you're giving them the exit. If they want to capitalize on the value of their business, you're giving them that because you're agreeing a purchase price with them. Yes, it's not being paid on day one, it's being paid over a period of time. But look, if their intention was to sell the business and whatever money they make from that sale, they were just going to invest anyway. Let's say they were going to deploy it into real estate, maybe they're going to do some buy-to-let investments. Well, if they deploy that cash into buy-to-let investments, well, in places like the UK, returns are pretty low, 5% maybe if you're lucky. You've got to deal with managing agents, moaning tenants, ever-increasing regulation, and all of those things come with their own stresses and challenges. Whereas what you could do is say, well, instead of having to deal with moaning tenants and all of the problems that go with all of that, I'll pay you a coupon. You could make that a better coupon than they would get from buy to let. Maybe it's 8%, maybe it's even 10%. You can pay them that maybe over a 5-year period. You pay back the full capital, you pay them the 10%. So you're giving them, a stress-free environment because they've only got to deal with you. And you're giving them a better passive income without all the hassle of something like buy to let that might create, and it's win-win for all parties. Now it's easier said than done, and clearly there's a lot of convincing to do that because ultimately they've got to trust that you're going to pay them when you say you're going to, and that their capital is protected. And there's a few things you can do with that. Really, it's about rapport and relationship, and being able to demonstrate track record and what you've done before, and what your plans are with the business, so that they don't see you going in there and ruining that a business that potentially then puts the cash flow that's going to service their seller note at risk. And you can build in various securities and protections into the legal paperwork. And when we work with joint venture partners, we work with them so that they understand these sort of creative structures. That was just one example, but we're quite adept at being able to present these types of structures and get business owners agreeing. So yeah, sometimes you have to be creative, but it's really about trying to get to a point of making a deal work win-win for all parties.
So another learning curve this year was an issue around a deal with deferred tax. Do you want to just talk a little bit about that and how you felt it was appropriate to deal with it?
Yeah, so I'm not a tax person. I'm not an accountant. I can understand financial statements and interpret them, but sometimes you have to defer to experts when problems arise and try and find solutions to them. So yeah, we were involved in a deal where it was a construction business. They owned quite a lot of expensive plant and machinery, and they'd done something with their tax return previously, which essentially meant that they had a deferred tax liability. So they effectively had saved quite a lot on corporation tax. But essentially, when we were doing this deal, a fundamental part of the deal was that the plant and machinery was going to be retained by the seller and leased back to us, and that would then create a passive income for them. But the problem with that was that if you removed those assets, it would trigger that deferred tax, which in this example was about 1.2 million. So it was quite sizable. So we had to be creative. So in the end, we left all of the assets within the company. We increased the purchase price accordingly, and we raised finance against those assets. So essentially, those assets still sit within the company, and it doesn't trigger the deferred tax liability at some point in the future. So yeah, I didn't know a great deal about deferred tax, and I'm certainly not professing to be an expert. But yeah, sometimes you get nuances like this that crop up in due diligence that you weren't expecting, and you have to work creatively and with the experts to try and figure out a suitable solution that deals with that issue and makes the deal work.
Okay, so there seems to be more discussions about potential deals and working capital. Can you share, I suppose, what you're seeing right now in 2025 with that?
Yeah, so I mean, one of the things that you can do is you can buy a company on a debt-free, cash-free basis. So essentially, on deal day, you get the business, you pay a price for that, but you also then have to fund working capital. So you're essentially having to probably borrow more money than you will have borrowed to do the deal to support working capital. An alternative way to structure a deal would be to not buy it on a cash-free, debt-free basis, and to essentially, when you buy the shares of a company, you're getting the company, which then comes with its working capital assets, so stock, inventory, trade debtors, all of those things turn into cash over a period of time, and out of that you then settle your liabilities, your creditors, etc., etc. So sometimes taking over a company with those assets, with working capital funding already in place, it can be a better way to structure it. Assuming debt also can be another way of positioning things. So working capital is really important. We never want to get into a deal where there's going to be a deficiency in working capital. So we're always doing some really detailed financial modelling around what is the working capital position of the company, and we're making sure in the vast majority of deals that enough working capital is in the deal on closing and the bank account isn't emptied, and then you're sort of up shit creek with trying to figure out how you're going to keep the business going. So we want to always max that position.
So do you find that people will generally use the due diligence to knock down the price?
Yeah, so it's for most buyers that tends to be a strategy. They go in, they tell the business owner all the reasons why their business isn't very good and why it's not worth the money, and maybe they get a deal using that strategy. But then they go and do due diligence, they find some other issues, and then they throw those issues at the business owner to try and knock the price down further. From our point of view, we actually don't do it that way. We do it completely the reverse. This for me is a sales and marketing process. You're marketing to find a deal, and then it's a sales process to convince the business owner to sell to you and not somebody else. So a lot of that is around building rapport and relationships. And I think you would really struggle to do that if you started picking holes in their business. So we don't do any of those things. And generally, we use the due diligence process not to knock down the price, but to really learn the business, understand how it operates. Of course, we're looking for issues and risks, and we're trying to build protections and mitigation against those risks. But look, if there was something fundamental, we'd probably just back out the deal. If there was a real big problem that we didn't feel comfortable with, then obviously we're not going to do the deal. And sometimes the best deals you do are the ones you walk away from. So no, we don't use the due diligence process to knock down the price. We use it to learn the business, going in with our eyes open, so that we have a much stronger chance of getting ownership of that business quickly and doing a good job then of running it with our eyes open, rather than seeing some problems and then using that to justify why we would pay less.
And how can you use warranties and indemnities to protect yourself in the example of completion accounts and balance sheet difference?
Yeah, so let me just explain what warranties and indemnities are. So warranties are essentially assurances that the seller will provide to us as a buyer concerning various facets of the company. So, in a long established company, it's very difficult to go and review absolutely every single document and transaction that they've ever done. So rather than us doing all of that, we'll build certain warranties into the eventual contract that give us protection. So rather than us check things out, we're just relying on the seller to say, yeah, I agree. This is the situation, and none of these problems arise. And then an indemnity is essentially a provision to which the seller promises to pay the buyer some money if a certain event happens. So a simple example of that could be, let's say in due diligence, we find there's a customer that's not paid its bill for a long time, and potentially there's a risk that that could turn into bad debt. Well, we might be able to say, if that does turn into a bad debt within the next 12 months, then you agree to pay us that money back, or you agree to knock that off the deferred consideration of whatever may be outstanding. So when we do a deal, it's not uncommon for us to sort of factor in completion accounts. So we'll base the deal on maybe a multiple of profit. We'll also look at the balance sheet and what it's worth and factor that into the calculations. But if I tie up a deal today, chances are it might not complete for 4 or 5 months. But during that time, if you're buying a profitable performing business, that balance sheet and net asset position is going to grow. So one of the things that we would want to do is, complete the deal based on, the last set of numbers that we've got, but we do an adjustment for completion accounts and say, well, look, if the balance sheet is worth more, probably, or less, then we adjust the purchase price accordingly so that they basically get the benefit of the increased reserves in the balance sheet. Now, there are many things that can affect the balance sheet. And in that bad debt example, in the net assets, that bad debt will be showed as a trade receivable. But if, after completion, we then find out that that turns into a customer that can't pay its bill and they go bust, and then maybe that 50 grand invoice doesn't get paid, then that essentially reduces the net asset value by the same amount. So in that scenario, we could either seek an indemnity or a price adjustment based on that sort of scenario. So I don't want to get too complex and complicated because this is sort of accountant's territory, but this is the sort of stuff that we're constantly looking at when we're looking at deals.
Okay, so what would you say is your biggest learn of 2025 for yourself and your JV partners?
I wouldn't say it was something specific. It's just more underlying something that's always been quite important to me. So, basically, I'm a strong believer that if you're going to do something and you don't know how to do it, then you go and find somebody that's been there, done it, worn the t-shirt, has the expertise, and either you learn from that person, you get them to do a job for you, et cetera, et cetera. So if you use the deferred tax example, that was very much new territory to me. It was quite a complicated area of tax law. So, by having an accountant on our team that is ex Big Four accounting firm, expert on tax, expert on UK company law and all of that sort of stuff, we were able to defer to his expertise to basically come up with a solution that was going to work. And when we joint venture with people, essentially people tap into not just our expertise of 100 plus transactions, but also the expertise of the various people on the team, whether it be a top four accountant, an international corporate M&A lawyer, the best corporate finance partners that we can find. So yeah, just leveraging other people's experiences is a constant thing. And 2025 for me is really just reiterated all of that.
Okay, so if people want to know more, where should they look?
So anybody that's interested in doing deals, wants to joint venture, wants to understand more about how we can work together, then reach out. We can book a call. We can have a chat either with me or my team, and we can explore whether or not there is the right opportunity to collaborate.
Okay, perfect.
Okay, cool.
Can I ask you a favour? If you like this content, then please do subscribe to the channel to receive more content like this as we upload it. It helps our channel and shares the message with like-minded deal makers. It also helps me to connect with our audience and bring you more content that you can watch.